What's up, everybody? Ryan Pulis here from the Pulis Group. We're a tax and accounting firm specializing in tax planning for real estate investors and small business owners. Today, I'm going to go over a few common real estate key performance indicators, also called KPIs. A little different than usual, we're not doing the tax tips today, but we're going to go over a few metrics that are pretty common in the real estate world and are something that every investor should know. So we're going to take a look at a spreadsheet here you see on the screen that shows us how to calculate a property's capitalization rate, also referred to as a cap rate, and how to calculate a property's cash-on-cash return. So on this tab, I've created two scenarios based on the assumptions listed at the upper left-hand part of the screen. The assumptions such as purchase price, interest rate, etc. update the areas below, which are all coded with formulas. You can update this for your own actual numbers. I'll try to put a link to the spreadsheet on my website and put that into the comments section below. You'll probably want to insert rows down here where you see OPEX for operating expenses, so you can list out your actual expense numbers rather than having them roll up in a single line, and you can input your own monthly rent numbers. But for now, I kept it simple just for illustration purposes. Bottom line, if you know how to do some basic Excel formulas, you'll have no problem updating this. A few notes: the orange colored cells up here are for data inputs, and the gray cells are automatically calculated based on those inputs. Some of the gray cells have orange text, which generally reflects a formula, and others are gray cells with black text, which generally represent output. I know sometimes I use them interchangeably, so don't put too much into the text color. Rather just know they're calculated amounts based on the inputs that are put into the orange cells. It's a very simple spreadsheet. Obviously real life scenarios are going to be more complex than this, but hopefully this will give you a decent understanding of how a property will perform. So let's briefly discuss the assumptions being made on this tab. In our scenario here, we assume a purchase price of $100K up here in cell C4 with a 25% down payment, which is pretty typical for real estate investing. We're going to borrow the rest at 4% over 30 years. The land value of the property we assume is 25%, and that gives us a 75% allocation to the building structure cost. This will become important to know for depreciation purposes. We'll take a look at that a little later. We're assuming a rent to value ratio, or RV ratio, of 1%. I chose 1% because that's a general rule of thumb when it comes to residential rental real estate. You'd like to have monthly rent equal to or greater than 1% of the purchase price. So you'll see that our property is renting out for $1,000 a month, which is exactly 1% of our $100,000 purchase price here. Another rule of thumb that we're using in this illustration is that operating expenses will equal about 50% of your gross rents. So that's what this OPEX percent is here. OPEX is just shorthand for operating expenses. Your operating expenses generally include your management fees, real estate taxes, insurance, repairs, items like that. It's the costs that go into running your property day to day. Mortgage payments are not reflected here because they tend to vary from investor to investor. Someone with really good credit will have one rate, while other investors may have a different rate, which is going to impact that payment. And some investors may pay cash and not have a mortgage payment at all. The net operating income number is your gross rent minus your operating expenses, and that should reflect the property's performance rather than the investor's credit or financing choices. That's why we don't include your mortgage payment above and operating expenses. You'll see that there's two different sets of calculations here. On the left, we're looking at the property's cash flow. On the right, we're looking at the projected taxable income. The difference between the two really is down here beneath the net operating income line, you'll see the expense names are in red text. On the cash flow side, we're deducting the entire mortgage payment, which includes both interest and principal. On the taxable income side, we only deduct the interest portion of the mortgage payment because principal paid on a loan is not tax deductible. And we also have a deduction for depreciation on the taxable income side because the IRS allows depreciation, which is a non-cash deduction allowed to recover the cost basis of the building structure. This is where that 75% allocation to the structure comes into play. You cannot depreciate land. So if we, in our example here, with 75% of the purchase price being allocated to the structure, will depreciate about 3.6% of that cost each year, which is 1 divided by 27 and a half years gives you just over 3.6%. 27 and a half years is what the IRS requires we use to depreciate the structure of residential real estate. If this was a commercial property, we would depreciate it over 39 years. So now let's get to the two KPIs that we're discussing today. The first is cash on cash return. You'll see this is highlighted in yellow just below our assumptions area. Cash on cash return is the annual cash flow produced by a property relative to the initial investment. This is calculated by taking your annual cash flow and dividing that by the amount of cash you put into the deal. In this example, we see cash on cash return of 6.81%. That is found by taking the 1,703 annual cash flow from cell D28 and dividing that by our down payment of $25,000, which is our $100,000 purchase price times the 25% down payment. So if we change that and say we wanted to put down 10,000 rather than 25, you can see that our cash on cash return jumps up to 8.44%. This increase comes even though our annual net cash flow decreases. That's because we are using more leverage in this scenario and our down payment dropped considerably more than the amount of the decrease in our net cash flow. Sorry, I lost my train of thought there. So the next ratio or calculation we want to look at is the capitalization rate or cap rate. So the cap rate is a measure that estimates the potential return on investment for investors and is used to compare different properties in similar markets. This metric is calculated by dividing net operating income, or NOI for short, by the market value of the property. If the NOI of a property is known, you can use the cap rate to back into an estimated purchase price. And we'll take a look at an example doing just that shortly. So in our example scenario here, we see a cap rate of 6%. We get to that by taking the $6,000 annual net operating income in cell D22 divided by the purchase price in cell C4, which is $100,000. If we change the purchase price and or the down payment percentage, you'll notice the cap rate stays at 6%. Let's go back up here. We'll change our down payment back to the 25%. And if we want to change our purchase price to $200,000, whoops, and our down payment to 30, or back to 25 and 50, or back to 100, you'll see our cap rate remains unchanged at 6%. So the reason that happens is because the net operating income in our examples here is driven by the RV ratio and the operating expenses as a percentage of rent. So our RV ratio, 1% per month, if that's annualized, we get 12% on the year, and our operating expenses are fixed at a 50% of gross rent, so 50% of 12% equals 6%. So if we want to see a change in our cap rate, we need to change something that's going to impact the net operating income. So let's see what happens if we manage expenses a little better and that operating expense percentage changes to 45% of gross rents. Well, our cap rate jumped up to 6.6%. Let's say we also improve our RV ratio from 1% to 1.25%. Now our cap rate's jumped up to 8.25%. So both changes improved our NOI, which in turn improves the cap rate on the property. Now let's move on to the deal analysis tab and see how the cap rate can help us determine how much you want to pay for a property. So here on this deal analysis tab, we have some inputs for a hypothetical property. In this case, we have our rent and expense numbers. The numbers in these examples are totally made up and they're different from the numbers we were looking at on the prior tab. So looking at the data in column C, we input our annual rent and expense numbers, which give us a net operating income of $16,500. If we decide that we want a cap rate of 7% or higher, then we input that here into cell C14, or 7%. And that tells us for a property performing as this one does with a net operating income of $16,500 a year, the most we should pay is $235,000, $714. So just over $235,000 if we want a cap rate of 7%. And this calculation is just our NOI divided by the 7%. So our purchase price here, we can now use this to calculate what our cash on cash return will be for this property. Our estimated purchase price flows over here to cell G19, the $235K. You can play with the cash on cash return calculation by changing the input assumptions down here in the the orange cells, the down payment percentage, interest rate, and the loan years. So our initial amounts here are set to 25%, again, pretty standard for investment real estate, an interest rate of 4% with a 30-year loan. So this is giving us a cash on cash return of 10.81%. You can see that in the green highlighted cell in G17. If we decide to put down 20% and we improve our rate to, let's say, 3.5% on that 30-year loan, then our cash on cash return jumps up to 13.45%. Now what if we say 7% cap rate's not good enough? We want something performing at 8%. We'll update that, and now we see a revised purchase price down to $206,000, and our cash on cash returns jumped up to over 18%. So, and this tool here is kind of just designed to help give you an idea of how these calculations can be used and allow you to get a good feel for the numbers. It's it's very simplistic. Just there is a useful guide, but I thought it may be helpful to present this and do a little video. One more thing before we wrap up. There's a third tab for mortgage amortizations. So this tab has two different amortization tables based on the other two tabs. So here on the left, all the inputs from the cap rate and cash on cash tab, the first scenario or first screen we looked at, have pulled over here and calculated our mortgage payment, the interest and principal payments, calculating it down through the 30 years. And then on the right hand side, you can see this comes down, works out to zero, so you know the calculations are working correctly. On the right hand side, we have the same exact calculations, with the only difference being the inputs pull over from our deal analysis tab that we were just looking at a few minutes ago. So the assumptions are the only thing changing here, and they're tied to the other two tabs. So making a change on one of these two tabs will update the amortization tables. So that about does it. I hope this video was helpful. Feel free to comment below and hit the like and subscribe button. We're always taking on new clients, and if you'd like to work with us, then hit us up on our webpage at thepulisgroup.com/contact. That's ThePulicegroup.com/contact. Thank you and have a great day.